Hello everyone and welcome to this Sage webinar on Brexit and VAT processing. My name's Ian, I'm one of the trainers here at Sage and I'll be taking you through today's session. Let's take a look at today's agenda. So we'll start by giving you a quick overview of Brexit. We'll then move on to what's changing, starting with the UK including Northern Ireland, then moving on to cover the Republic of Ireland. It's absolutely worth creating a Brexit impact assessment to see what changes you may need to make within your business, and we'll cover an example of that. We'll then focus on how Sage can help. As part of this, we'll look at the new functionality within both Sage Business Cloud Accounting and Sage 50 Cloud Accounts that will assist you in processing under the new legislation. There'll be plenty of time for questions and answers at the end, but please remember that you can ask questions at any point during the webinar, and we'll respond to these as soon as we can. Before we jump into the webinar today, I would just like to capture some information from you first. This will help us understand our customers, but also to shape our future sessions. What I would like to know is, which of our accounts products are you currently using? Is it Sage Business Cloud Accounting, Sage 50 Cloud Accounts, or neither? So if you could just type your answer into the questions panel for me, please. Again, this just gives us an idea of who we have on our session today. So before we look at what's changing, let's start with a quick overview of Brexit. I'm sure you're all very familiar with the word Brexit, but just to give you a bit of a recap, it's an abbreviation of the words British and exit, and the official definition from the Oxford English Dictionary is the withdrawal of the United Kingdom from the European Union. Just to cover a little bit of the timeline on this, because the process started approximately 4.5 years ago now, on the 23rd of June 2016, when the UK public voted to leave the EU. The following March, 29th of March 2017, the government triggered Article 50, which is an EU treaty that sets out how EU states can leave the EU with Parliament approval, thus starting the 2-year countdown to the 29th of March 2019, which was originally intended to be Brexit Day, when the UK would leave. But there have been various delays and postponements, and at the start of this year, 31st of January 2020, we finally officially left the EU and entered the transition period. That transition period has nearly ended and will officially end on the 1st of January 2021. So as we've just said, on the 1st of January the transition period will end, which means, amongst other things, the UK will leave the EU VAT regime. And this means that the UK will need to treat sales and purchases to and from the EU as rest of the world exports and imports, and can no longer treat them as intra-community supplies and acquisitions. Similarly, other EU countries, including the Republic of Ireland, will also need to treat sales and purchases to and from the UK as rest of the world exports and imports. This will mean these goods will now have to go through a complex export and import process. It will also impact how UK businesses apply VAT to these transactions and account for them on their VAT return. However, these changes are complicated by the Northern Ireland Protocol, which keeps Northern Ireland tied to the EU in respect of goods. So what do we mean by the Northern Ireland Protocol? Well, the aim of it is to avoid a physical border between Ireland and Northern Ireland, and the implications are expected to be the same regardless of whether the EU and UK reach a free trade agreement or not. Under the protocol, EU VAT rules will apply to Northern Ireland in relation to goods, but will not apply in relation to services. And this has resulted in much uncertainty around what trade between Great Britain and Northern Ireland will look like. Although it's worth saying that HMRC's view is that this is now largely defined. In fact, HMRC has recently published additional guidance around Northern Ireland and VAT. And the guidance confirmed that you're trading under the protocol if your business is VAT registered, and either your goods are located in Northern Ireland at the time of sale, you receive goods in Northern Ireland from VAT registered EU businesses for business purposes, or you sell or move goods from Northern Ireland to an EU member state. You'll be automatically identified as falling within the scope of the protocol if your VAT registered address has a BT postcode, and VAT registration certificate shows a type of business that's not solely involved in the provision of services. To check if you're trading under the Northern Ireland Protocol and what to do, there is excellent guidance on the gov.uk website via the link you can see on screen. Let's move on then and take a look at what's changing, starting with the UK, including Northern Ireland. First, let's look at importing goods, business to business or B2B. So before the transition, if we start with importing goods from the EU, they're referred to as acquisitions and no custom processes are required. UK VAT would be applied via reverse charge, and VAT is calculated by the customer based on the invoice value. And the tax point's dictated by the normal tax point rules, which is usually the invoice date. In terms of importing goods from the rest of the world, they're referred to as imports, and UK import VAT would be applied at customs. VAT itself is calculated by customs based on the import value, and the tax point is the date that goods were cleared for free circulation at customs. Post-transition, all imports to Great Britain will be treated how rest of the world imports are treated today. Northern Ireland will continue to treat EU acquisitions and rest of the world imports as they do today. However, to ease this process, import VAT can be accounted for via postponed accounting. The UK government have confirmed that postponed accounting will be available for all imports, so that's EU and non-EU, from the 1st of January. Like the reverse charge mechanism used for EU trade, whereby import VAT is not physically paid up front and then reclaimed on the subsequent VAT return, but is instead accounted for as input and output VAT on the same return. The net effect's the same, but the importer benefits from not having the initial cash outflow, which is then recovered. It's optional on an import declaration basis, but it's mandatory if you defer the submission of customs declarations. A new online monthly statement will be available, which will show the import VAT postponed for the previous month on a transactional basis and when you should include it in your VAT return, i.e. the correct tax point. Postponed accounting will be available for all UK businesses, including Northern Ireland. Northern Irish businesses will not need postponed accounting for goods coming from the rest of the EU because there's no import VAT, but they could still use it for rest of the world imports and potentially for imports from Great Britain. To summarise postponed accounting, let's take a look at how it works without postponed accounting versus how it works with. So without postponed accounting, UK VAT registered businesses importing goods to the UK will be required to pay import VAT on or soon after the time that the goods arrive at the UK border. But with postponed accounting, those UK VAT registered businesses importing goods to the UK will be able to account for import VAT on their VAT return, rather than paying the import VAT on or soon after the time that the goods arrive at the UK border, so they don't have that initial outlay of money. Something else that's new is the £135 import scheme for the import of goods. So at the end of the transition period, the UK government will introduce a new model for the VAT treatment of goods arriving into Great Britain from outside of the UK. This will ensure that goods from EU and non-EU countries are treated in the same way, and that UK businesses are not disadvantaged by competition from VAT-free imports. For imports of goods from outside the UK, in consignments not exceeding £135 in value, the point at which VAT is collected moves from the point of import to the point of sale. This means that UK supply VAT rather than import VAT will be due on these consignments. For business to customer, the UK VAT will be charged by the foreign seller. For business to business, the UK VAT will be reverse charged to the UK customer. The scheme is mandatory and it's for Great Britain only, so it's not relevant for Northern Ireland. Something else to mention is that low value consignment relief, or LVCR, which relieves import VAT on consignments of goods valued at £15 or less, will be abolished due to this new arrangement. If you want to find out more about the new scheme, you can do so via the link you can see at the bottom of the screen. Now, we just mentioned that scheme isn't relevant for Northern Ireland. So if you want further guidance on how VAT will apply for goods imported into Northern Ireland from outside the UK or EU, you can find that using this link you can now see on screen. Moving on to services then, and before the transition, the general rule is that business-to-business sales of services are generally subject to VAT in the country of the customer, with some exceptions. Therefore, VAT is usually applied in the country of the customer via reverse charge. Business-to-customer sales of services are generally subject to VAT in the country of the seller, but with some exceptions. Digital services covered by the MOS scheme, for example. Therefore, generally the seller should apply UK VAT. Otherwise, apply VAT of the destination country, which you may be able to report through MOS. After the transition, these basic rules are the same globally and will not change as a result of Brexit. However, the UK, so both Great Britain and Northern Ireland businesses, will have to start using the non-union MOS. And UK businesses will no longer be able to apply the €10,000 MOS threshold, meaning more businesses may register for MOS and have to apply VAT of the destination country. Just to emphasise that these are general rules, but it does illustrate that, with the exception of registering for the non-union MOS scheme for services, you'll likely carry on doing what you are today. If you're in any way unsure, please speak to your accountant. Next, we have exporting goods. So pre-transition, starting with exporting goods to the EU. For business-to-business, intra-community business-to-business sales are known as supplies. Providing the supplier has verified the customer's VAT number, the invoice is zero rated, and VAT is applied to the destination country through the reverse charge. For business-to-customer, intra-community business-to-customer sales are known as distance sales. Below the distance selling threshold, VAT of the seller's country is applied. And above the threshold, the seller has to apply VAT of the destination country. For exporting goods to the rest of the world, all rest of the world exports are zero rated for UK VAT, regardless of whether they're business to business or business to customer, and tax may be applied in the destination country via import procedures. Post-transition, all exports from Great Britain will be treated how rest of the world exports are treated today. This may result in additional EU VAT registrations, and Northern Ireland will continue to treat EU supplies and rest of the world exports as they do today. Something else that's changing is the VAT return. Now, it was originally anticipated that there would be no changes to the wording of the VAT return boxes as a result of postponed accounting or leaving the EU VAT regime. But in November 2020, this decision was reconsidered, and boxes 2, 8 and 9 will be changed. These changes don't take effect until the 8th of April 2021, and the function of the boxes will remain the same. But just for your awareness, the new wording of those three boxes is as follows. So box 2 will say VAT due in this period on intra-community acquisitions of goods made in Northern Ireland from EU member states. Box 8 will say total value of intra-community dispatches of goods and related costs excluding VAT from Northern Ireland to EU member states. And finally, box 9 will read total value of intra-community acquisitions of goods and related costs, excluding VAT, made in Northern Ireland from EU member states. Other things to consider are EC sales list, Intrastat and MOS. Starting with EC sales list, and any goods sold under the Northern Ireland Protocol should continue to be reported on an EC sales list. Other than this, EC sales list will no longer be required. For Intrastat, businesses moving goods under the Northern Ireland Protocol will still be required to prepare Intrastat arrival and departure declarations for these goods. Goods not covered by the Northern Ireland Protocol will still need to be reported on Intrastat arrivals declarations, but that's only on a short-term basis for 2021 in order to gain the required statistics. Finally, Mini One-Stop Shop, or MOS. Any business using the VAT MOS scheme will need to transfer from the Union scheme, which is for businesses in the EU or have a branch in the EU, to the non-Union MOS scheme for businesses not established in the EU. You can find more information on MOS and the link you can see on screen. Then we have Northern Ireland VAT registration. Under the Northern Ireland Protocol, EU VAT rules will continue to apply in Northern Ireland after the end of the transition period in respect of goods. In terms of change, if you're trading and make transactions under the protocol, you'll need to use an XI prefix in front of your VAT number when communicating with an EU customer or supplier. So your invoices will show an XI number ahead of your VAT number. For example, XI 123456789 instead of GB. It's worth pointing out though that as far as we're aware, there's no requirement to apply for or be issued with an XI VAT registration, i.e. it's sufficient just to use the XI in front of your existing number. EORI numbers next then. So if you import or export goods into or out of the EU, you need an EORI number. Previously, this would only have been a UK requirement for imports and exports outside of the EU. But from January 2021, there'll be a requirement if you move goods between Great Britain, so that's England, Scotland and Wales, and the EU. You may also need one if you move goods to or from Northern Ireland. And if you move goods between Northern Ireland and non-EU countries, you'll need an EORI number that starts with XI. If you need to get an EORI number, then you can do so from gov.uk/EORI. Let's move on to commodity codes, which are standardised numbers allocated to goods in order to classify them for the purpose of calculating the correct tariffs and taxes upon importation into a country. They're required for import and export declarations, but aren't required for EU intra-community trade, although they are used for Intrastat reporting. Previously, UK businesses therefore only had to use commodity codes when trading outside of the EU, or for completing Intrastat reporting, but will now be required to use them when trading with the EU. Commodity codes aren't a requirement for a VAT invoice, but they should be included on any commercial invoice. If you need to look up commodity codes, duty and VAT rates, go to gov.uk/trade-tariff. That's the UK covered then, but what's changing in the Republic of Ireland? Let's take a look. Well, first of all, sales of goods to Great Britain will now be treated as rest of the world exports. Any sales of goods to Great Britain with a consignment value under £135 will now be covered by the new UK import scheme. For business to business, UK supply VAT is accounted for by the customer via a reverse charge. For business to customer, UK supply VAT is charged by the seller who will need to register for UK VAT. Purchases of goods from Great Britain will now be treated as rest of the world imports. Sales and purchases of goods to and from Northern Ireland will continue to be treated as intra-community dispatches and acquisitions. But you will need to use a new XI country code to reflect these transactions on supplementary reporting and use the XI VAT registration for Northern Ireland customers and suppliers. Great Britain should be excluded from Intrastat reporting and EC sales reporting, and Northern Ireland should be excluded from a services perspective. UK, so that's Great Britain and Northern Ireland, should be excluded from MOS reporting. Any UK VAT due on business to customer sales of services will now require the seller to register for UK VAT. And finally, you will need to use EORI numbers and commodity codes when trading with Great Britain. We talked about postponed accounting in relation to the UK a little bit earlier, but in terms of the Republic of Ireland, under previous no-deal Brexit preparations, the Republic of Ireland confirmed that they would also implement postponed accounting. And this was to reduce friction and cash flow impact on Irish businesses of import VAT as a result of trade from Great Britain to the Republic of Ireland. Now, the underlying legislation required for postponed accounting in Ireland has now been laid before Parliament and will make its way through the various stages. Revenue have issued some high-level guidance, which hopefully provides some reassurance that it is coming and will be in place for the 1st of January, along with the required changes to the VAT3 and RTD forms. And you can find this information on the link you can see on screen. Finally, from a legislation changes perspective, it's worth considering a Brexit impact assessment. Some tangible things to think about and do to be ready for January. Let's take a look at an example. So here are 5 questions for you to answer to ensure you've got everything in place for the end of the transition period. Starting with import, export and logistics. So does your business import or export goods to or from the EU? On the back of that, we've got EORI. Do you need to register for an EORI number? And remember, you've got the link that we talked about earlier. Northern Ireland Protocol. So does your business trade under the protocol? In terms of taxes and money, is your business VAT registered, or do you operate under the VAT MOS scheme? And finally, software, which we'll talk about in a minute. Is your account software up to date? That brings us to the end of the legislation part of the webinar. So now it's time to look at a few different ways in which Sage can help with Brexit and VAT processing, starting with our software. So let's talk product. First up is Sage Business Cloud Accounting. Over the next few slides, we'll look at some of the key features being introduced into our Sage Business Cloud Accounting solution to support you with EU transactions post-Brexit. Just to make you aware, to determine the tax treatment of the transaction, Sage Business Cloud uses a combination of postcode checks, whether the invoice includes goods or services, and whether postponed accounting or the £135 scheme applies. Therefore, it's really important that both your business postcode and that of your customer or supplier have been set up accurately. Here we're set up as a business in Belfast with a BT postcode. If we select our GB supplier, we can process as normal. No banner appears as no borders are being crossed. If we select our Irish supplier in Dublin, however, the banner appears to indicate that they are an EU supplier and reverse charge may apply. Finally, if we create an invoice for our Spanish supplier, again we're presented with the banner indicating that reverse charge applies and the tax treatment has changed to 0 rated. It's also key to check each line of the invoice to ensure they are correctly flagged as goods or standalone services if the option is available. It's the same for those processing in the Republic of Ireland. So as a comparison, let's take a look at a company setup with a Dublin address. First, if we select the GB supplier, the banner indicates that Great Britain is outside of the EU and may be charged under the reverse charge mechanism. If we change this to our Northern Ireland supplier, the banner changes to indicate that they're in the EU and again this may be charged under reverse charge. So it's key to ensure that the item is correctly flagged as goods or services using the drop-down option. Finally, if we choose our supplier from Spain, the banner disappears and the transaction is posted as normal for invoices from the EU. If you look at the top of the slide, the first feature we'll be adding to Sage Business Cloud Accounting is the option to activate postponed accounting. This can be found within Financial Settings and under Accounting Dates and VAT settings. Once activated, this can be overridden on an invoice-by-invoice basis. The checkbox then sets the defaults. For Ireland, it sets the defaults for importer invoices and treatment for the rest of the world import transactions. For the UK, it sets the default for importer invoices and always estimates VAT for a rest of the world purchase invoice. If you don't want to estimate VAT, you can select 0 rate. If you look at the two screenshots underneath, you also need to indicate which of your suppliers are import agents. On current supplier records, this can be indicated within their account details, and for new suppliers, this can be selected when creating the record. Let's take a look at how this works on an invoice. Once a supplier who's been flagged as an import agent is selected, the new postponed accounting box appears. This can be cleared if it does not apply to this transaction. If selected, the transaction will be posted with postponed accounting rules and will automatically impact boxes 1, 4 and 7 on the VAT return. When reviewing an invoice already posted, if postponed accounting was applied, this will clearly show in the banner to indicate that this was the case. Next, we'll take a look at how Sage Business Cloud Accounting takes care of those imports which fall under the £135 threshold. As you can see here, we begin with a GB supplier selected. However, as soon as we change the supplier to our EU supplier in Spain, the banner changes to reflect that the customer is in the EU and reverse charge may apply. The checkbox to apply the £135 consignment rule also appears. Remember, it is here that we need to indicate the invoices for goods to be eligible for the scheme. Some additional reports have been introduced to enable you to reconcile your VAT returns. Outside of postponed accounting, import VAT is estimated until further documentation is received. The Overseas Purchase of Goods report will assist you when reconciling your VAT return, but it will also allow you to view rest of the world purchases, EU purchases, and import invoices, along with the associated postponed VAT. There is also the Overseas Sales of Goods report which allows you to differentiate between your rest of the world and EU sales. There are limitations on certain transactions being used with overseas contacts. Quick entries cannot be used for overseas suppliers. The transaction must be entered as an invoice. Similarly, within bank, other payments and other receipts cannot be used for customers and suppliers overseas. These are blocked, and messages will indicate this. Let's move on then to Sage 50 Cloud Accounts and the new functionality in version 27.1 that will assist you in processing under the new legislation. Sage 50 Cloud Accounts will work differently to Sage Business Cloud Accounting, and for this we're introducing some new tax codes to support you with processing after the transition period ends. Let's take a look. When opening your software for the first time after installing version 27.1 in the UK, you'll be presented with this prompt that new tax codes are being created. The same thing will occur if a backup's restored from an earlier version. So we click OK to the prompt. These tax codes can be reviewed at any point via Settings, then Configuration and Tax Codes. It's worth noting that if these tax codes are not available, it will select the next 5 available consecutive tax code numbers to use. Here we can see in more detail the new tax codes that are created. These tax codes will be blocked from being used on sales transactions, bank transactions and journals, so will only work on supplier transactions. T15 and T17 are notional VAT, i.e. the tax code has a link to a particular rate, and the VAT amount is calculated at the point that the VAT return is run. T18 is slightly different in that a VAT value is physically entered in the batch window. This VAT value still hits boxes 1 and 4, but works slightly differently to T15 and T17, and this will be demonstrated in the next video. T17 is to be used when the £135 import of goods scheme applies. The transaction must be below the £135 consignment threshold. Going back to T18, and this is the code used when postponed accounting is in play, and automatically posts a VAT-only credit note to correct the supplier balance. Let's look at this in more detail now. So as promised then, let's take a look at using the T18 tax code for when postponed accounting applies. So if I pick my supplier and choose to do a batch supplier invoice, enter my net amount and we're going to choose a T18 tax code. And you'll see that that calculates VAT and it will also let me overtype the VAT amount. When we save the invoice, we get a message prompting us that we're using a tax code for postponed accounting to make sure we're doing the right thing and to tell us that it's going to post a VAT-only credit note which will not affect the VAT return. And that's to offset the supplier balance. If we now run the VAT return by clicking on VAT, pop in our dates and choose to calculate the VAT return, we'll see as we wanted it to, the transactions have affected boxes 1, 4 and 7, and because we're postponing VAT, the net effect on box 5 is 0, so there's no VAT to pay or to reclaim. Similarly in Ireland, when opening up the software for the first time after installing version 27.1, you'll be greeted with a prompt to indicate that 12 new tax codes will be created. So if we click OK to that prompt, once we're in the software, again these tax codes can be reviewed at any time within Settings, then Configuration and Tax Codes. Here you can see the 12 tax codes created automatically. Again, if these are not free, it will select the first 12 free consecutive codes to populate. The table demonstrates the code that is currently used and what new code to use if postponed accounting is in play. It is important to note, however, that it's unlikely that one company will need to use all of these codes. So again, let's demonstrate one of these codes being put to use, and this time we'll look at T39. So we enter our purchase invoice for our GB customer, we enter our net amount, and as I say, we're going to use the T39 tax code. Again, we get the message to indicate the transaction is subject to postponed accounting, and to tell us that it's going to post the VAT only credit note. So if we save that and look at the transactions, we can see that's exactly what it's done. In addition to the invoice, we've got the VAT only credit note, which will not impact the VAT return. It's simply to correct the supplier balance. So if we have a look at the VAT return now, pop into VAT, look at the return, we can see the transaction is impacting boxes T1, T2 and PA1, which is exactly what we want it to do. If we reconcile the VAT return and flag the transactions as being VAT reconciled, and then run the return of trade in details, the RTD, we calculate that, we can also see that the transaction is impacting the RTD return itself, particularly the new PA boxes. So as we mentioned earlier, there will be changes to the UK VAT return, but these will not come into effect until April. The Irish VAT return, however, will see changes immediately. The box which previously showed intra-EU acquisitions has been extended to include the VAT value on the new postponed accounting transactions. In addition, there will be a new box, referred to as PA1, which will include the value of goods imported under postponed accounting, and will include carriage, insurance, and freight costs. In addition to the VAT return, there have also been some changes made to the RTD report. Row and column labels have been amended. As you can see, the last three column headers now contain wording around postponed VAT. The 9% and 13.5% were previously separate rows. However, they've now been merged into a single row. Plus we have the addition of boxes PA2, PA3 and PA4, which include postponed accounting totals. For more information on how the new tax codes impact the return of trading details, you can view a knowledge base article via the link you can see on screen. We talked about the need for an EORI number earlier. Remember that if you import or export goods into or out of the EU, you need an EORI number. Previously, this would have only been a UK requirement for imports and exports outside of the EU, but from January 2021, there'll be a requirement if you move goods between Great Britain, so England, Scotland and Wales, and the EU. The EORI number can be entered into the software via Settings, then Company Preferences. Also remember that link to get an EORI number if you need one, gov.uk/EORI. We also talked about the need for commodity codes earlier. Commodity codes have always been a feature in product records, in particular for Intrastat reporting, and will be required for commercial invoices from the end of the transition period. As detailed earlier, commodity codes can be found on the gov.uk website at gov.uk/trade-tariff, an example of which you can see on screen now. You can then enter the code in the Product Record Details tab. It's also worth noting that in order to produce a commercial invoice, there will be a new invoice layout in the latest release of Sage 50 Cloud Accounts, which is version 27.1. As mentioned earlier, under the Northern Ireland Protocol, EU VAT rules will continue to apply in Northern Ireland after the end of the transition period in respect of goods. If you're trading and make transactions under the protocol, you'll need to use an XI prefix in front of your VAT number when communicating with an EU customer or supplier. And your invoices will show an XI number ahead of your VAT number. For example, XI 123456789 instead of GB. To enable that, the XI country code has been created in the software via Settings, then Countries. This can then be applied to customer and supplier records within the Details tab. As well as the software itself, there are other resources available to you to support you with Brexit and VAT processing. Let's take a look at some examples. The first resource I want to point you towards is the Brexit Hub, which can be found at sage.com/en-gb/Brexit. It's packed with useful resources and information for Sage customers and partners preparing for Brexit, and is also regularly updated, so please do check back often. We also have the Sage Help Centre, which is our central hub for all help and support content, on which you can search our knowledge base for help on any topic. You can find the Sage Help Centre at sage.co.uk/help. We also have Sage Q&A Live, which is accessible via the Help Centre. There are live Q&A sessions run frequently throughout the day, where, similar to today, you can ask questions via the panel and you'll receive answers in real time from a technician. To join a session, you go to sage.com/UK/QA. All that remains for me to say is thank you very much for watching this video. Stay safe, and I'm sure I'll speak to you again very soon.